Picture this, the clock is ticking down, 30 seconds to the non-farm payrolls report. Your heart is pounding, your palms are sweating, but you feel prepared. You've done your analysis, the consensus points to a strong number, and you've identified the perfect entry point. The moment the news hits, you click buy. For a split second you see a flash of green, euphoria. But then, in an instant, the market reverses with violent, unimaginable force. The price plummets, blowing past your stop loss before you can even comprehend what happened. You stare at the screen, watching your account balance decimated in seconds. If this scenario sounds painfully familiar, I want you to know you are not alone. In fact, you've been conditioned to believe that this high-stakes gamble is the fastest way to make profits. The internet is flooded with gurus and so-called experts flashing screenshots of massive wins screaming, "Made 500 pips on the news?" They sell you the dream of instant wealth, fueled by the adrenaline rush of extreme volatility. They make you believe that if you're not trading the news, you're missing out on the easiest money in the market. But what if I told you it's one of the biggest, most sophisticated traps in all of Forex? What if I told you that the entire event is engineered to prey on the predictable reactions of retail traders just like you? The truth is, when you trade the news, you're not playing the same game as the big institutions. You think you're trading the economic data, but you're actually just providing the liquidity that the smart money, the banks and hedge funds, need to fill their colossal orders at the best possible prices. They create the chaos, and you pay the price. Today we're exposing the hidden truth about news trading. We're going to dismantle the myths and reveal why so many traders consistently lose money without even understanding the mechanics behind their losses. Have you ever wondered why the price spikes both ways, taking out buyers, sellers, or why your order gets filled at a price that was never even visible on your chart? This isn't bad luck, it's the system working as designed, so stick with me because this video is going to be a complete paradigm shift. First, we'll dissect the showing you what really happens on a microsecond level. Second, I'll reveal the you must know to protect your capital, the execution trap, the information trap, and the psychological trap. And most importantly, if you stay until the end, I will unveil the during high-impact events. This isn't about gambling on direction, it's a professional framework for profiting from the predictable chaos. By the end of this video, you will no longer be a victim. You'll have the knowledge to navigate these events like a true professional. News trading seems exciting, right? Huge candles, fast moves, instant profits. You see traders posting screenshots of 200 pip gains in seconds. But here's the truth. What you're seeing is only the highlight reel. For every trader who wins big, there are thousands who blow accounts instantly. Why? Because of two things, volatility and liquidity traps. Let me break it down. Here's the big secret, the one they don't tell you on financial news. The institutional players, the big banks, the brokers, they love it when you, the retail trader, decide to trade the news. To you, a major release like non-farm payroll looks like a golden ticket, a chance to catch a massive move and make a quick profit. You see the potential for a 100-pip move in minutes and think, this is my chance. But what you perceive as an opportunity, they see as the perfect setup for a trap. So, why do they love it? It boils down to one critical word: liquidity. For a bank that needs to move billions of dollars, they can't just click buy without sending the price skyrocketing against them. They need a massive pool of opposing orders to absorb their huge positions. During a news event, millions of retail traders jump in, providing that exact pool of liquidity. You're not a participant in the move, you're the fuel for it. You become the willing counterparty to their colossal trades, allowing them to enter the market precisely where they want, while you're left fighting the waves they create. And this is where it gets brutal. The first weapon used against you is the spread. During major news, your broker widens the bid-ask spread to an insane degree. That normal 1-pip spread on EUR/USD, it can instantly blow out to 10, 20, even 30 pips. This means your trade is immediately in a deep loss the second you open it. Your carefully placed stop loss is now just a few pips away from being triggered by the spread alone. Then comes slippage. You click buy at a specific price, but in the chaos your order gets filled 10 or 15 pips worse. That's money vanished into the market's volatility before your trade even had a chance to breathe. But the most cynical part of the trap is the fake out, the classic stop hunt. Let's imagine NFP data is overwhelmingly positive for the US dollar. Logic says EUR/USD should plummet. So what do the banks do? They often trigger a massive, lightning-fast spike. This move is surgically designed to do two things. First, it triggers all the stop losses from traders who were already short. Second, it lures in FOMO-driven breakout traders who see the upward momentum and jump in long. And then, once all that liquidity has been harvested, the trap springs. The market violently reverses, plummeting downwards in the direction it was supposed to go all along, wiping out everyone in one devastating move. This isn't random chaos, it's a calculated maneuver. They play on your logic and your fear of missing out. They create an environment so volatile that your trading plan becomes irrelevant. You're not trading against the news, you're trading against algorithms and institutions with a playbook designed to take your money. This is the reality of news trading, this is the big trap, and that is precisely why most people lose. Ask yourself this, if news trading was really the golden ticket, why do 90% of retail traders still fail? Why don't big institutions rely on news spikes to make billions? Because smart money doesn't gamble on randomness. They position themselves way before the news hits. They already know where liquidity is. When you're buying the breakout, you're actually giving your money to the market makers. Positioning beats gambling. First up, widen spreads and slippage. Your broker isn't your enemy, but during high-impact news, market dynamics change violently. The available liquidity dries up, causing the spread, the difference between the buy and sell price, to explode. A currency pair with a normal 1 pip spread might suddenly have a 20 or 30 pip spread. This means a new trade starts with a massive instant loss, making it almost impossible to be profitable from the start. Then there's its evil twin, slippage. In a fast-moving market, the price you click is not the price you get. You might try to enter a buy order, but in the milliseconds it takes to execute, the market has already surged higher. Your order gets filled at a much worse price, turning a potential winner into an immediate loser and invalidating your entire risk calculation. Second, and this is where it gets predatory, liquidity hunts. Big players, the institutional banks and hedge funds, use news as a weapon. They need enormous volume to fill their positions, and they know exactly where retail traders place their stop-loss orders, just below key support and just above key resistance. These clusters of stops are giant pools of liquidity. During the chaos of a news release, these institutions will deliberately push the price into these zones. They hunt for your stops, triggering a cascade of orders that provides them with the liquidity they need to enter their own massive positions, often in the complete opposite direction. It's a calculated maneuver, using the news as cover to engineer a move that benefits them at the expense of the retail crowd. This leads directly to our third point, the treacherous false breakout. That first explosive move you see immediately after the news hits, the one that makes your heart pound with FOMO, most of the time it's a trap. This initial spike is the result of the liquidity hunt we just discussed. It's designed to trigger stops and, crucially, to lure in emotional breakout traders who think they've caught the beginning of a new trend. They jump in, buying at the top of a huge green candle, but once the institutions have filled their orders and trapped the breakout crowd, they reveal their true intention. The price violently reverses, leaving all those FOMO traders caught on the wrong side of the market, watching their positions go deep into the red. So let's put it all together. Remember these 3 core risks: dangerously widened spreads, predatory liquidity hunts, and deceptive false breakouts. The key to surviving is to shift your mindset. Don't chase the first spike, trade the structure that forms the chaos. Let the dust settle, wait for the market to digest the news. Instead of jumping in on that first candle, wait 15 or 30 minutes. Look for a clear retest of a level, the formation of a new stable price structure, or a clear sign of rejection. This is where the high probability entries are found. Amateurs gamble on the news. Professionals trade the market's reaction. That patience is what separates consistent profit from consistent pain. Instead of chasing news candles, here's what smart money does. They trade liquidity zones, not headlines. They position at key order blocks and imbalance zones hours or even days before the news. They expect price to return to fair value after the initial spike. That's the difference between a gambler and a professional. So, is news trading a trap? Absolutely. If you don't understand what's really happening behind the scenes, before you hit that buy or sell button on NFP day, remember this video. If you want to survive in Forex, stop chasing the noise and start trading like the banks. Smash that like button, subscribe, and share.